Welcome to Growth TV and ACG Production. I'm Carolyn Vallejo. Today, we're joined by Tom DeMauro of Siemens Financial Services to talk about how trends like digitization are shaping M&A transactions today and how PE firms can find the right strategic partner to turn those trends into value drivers. Tom, welcome to Growth TV.
Thanks for having me, Carolyn.
First off, what are some of the biggest challenges impacting M&A transactions that you're seeing today?
Well, much of it comes after the acquisition these days. So the ability to navigate a middle market firm through this rapidly evolving, uncertain environment is really the dilemma. So obviously we have uncertainty abound. Tariffs are the uncertainty of the day. And we'll see how that sort of plays out over the next coming weeks and months. But also, we've been living in this different interest rate and inflation market. Labor input costs have been an issue that many of our borrowers have been contending with over the last 24 months or so. Supply chain resiliency has been an issue. Regulation will be another area of uncertainty in the next several months and years. These types of things manifest themselves ultimately in lower deal flow. On the M&A front, there's a larger valuation gap between buyers and sellers. We're seeing slow deal flow. This has been something we've been seeing over the last few years. Fewer deals means in an environment where PE firms have plenty of dry powder and there's ample capital availability on the lending side. It really just means higher competitive pressure on the acquisition front. So what does that mean? It means there's just much more pressure on execution. Many of the transactions we see, the investment thesis by the sponsor has an exit assumption with a multiple that's lower than their going in multiple. So they really need to find ways to create operational value add. Digitization, automation, electrification, these are areas where we're seeing a lot of our sponsors create value. And the problem with middle market firms is they're often ill-equipped to execute on these strategies, right? So that's the difficulty that they face. They have limited resources. They have digital skill gaps. Sometimes there's even a cultural resistance to make these changes. So that creates additional pressure for the PE firm to play that leadership role in driving these changes and providing strategic guidance. But speed is required. Sponsors have finite investment periods, and those early stages of the acquisition are the times when these strategies need to be identified. And the critical question really comes down to, are they able to identify the projects that can be executed that provide strategic value, and how do they go about executing on those projects?
Okay, you mentioned trends like digitization, how important it is, but also how challenging it can be. So how can investors tap into trends like this and turn them into opportunities?
Well, as I alluded to earlier, early assessment is critical. Right, so early assessment really comes down to the sponsor's ability to identify areas that are that will be critical for future growth. But really, much of that comes down to finding the right partners to work with to identify what is really workable. The goal for them is to really. It comes in various forms. So it could be accelerating product development cycle, could be harnessing automation to optimize processes, potentially enabling onshoring or reshoring as part of their manufacturing process. It could be adopting resiliency solutions to ensure against extreme weather events, factory downtime. So there are a variety of solutions that come into play, some of them more complex than others. It could be adopting technologies such as a digital twin for virtual prototyping. It could be adding IoT-enabled sensors to their equipment for real-time monitoring of their processes. It could be route optimization or route optimization software that will allow them to efficiently manage their fleet. But really, ultimately, the questions that need to be answered pretty early on from their partners is it feasible? What is the cost of implementation and what's the ROI? What's the timeline? And what are the execution risks? And these really need to be answered quickly. If they're answered quickly and with conviction, then the firm, the sponsor, can effectively allocate resources, and then they can attempt to execute and build to a sustainable advantage.
Okay, you just mentioned a couple important strategies there. How can working with the right strategic partner help PE firms implement those strategies?
Well, if you align with the right partners, the facts can be gathered to make the right decisions, right? So, as I mentioned before, is it feasible? What's the ROI? What's the implementation timing? SFS sits in a unique spot. For one, we're on the front line of the business assessment with the sponsor, not unlike many of their other lenders. But what we also have is the benefit of expertise and the capabilities of the broader Siemens enterprise. So whether Siemens has played a lead role or filled an execution gap in one of these executions as a firm, we've very likely been part of a very similar initiative. So for every business that we review from a lending perspective, we ask a couple of questions. Where does the sponsor want to take the business? Have we seen this before? And then is there any expertise that we can bring to the table? So I'll provide a couple of current and live examples. One is we have a lender or a borrower who's a intermodal service provider. The sponsor believed that they could make gains by modernizing their yard management equipment. They were not clear as to exactly what they could do or if this was feasible, or really what the cost and timeline was. So what we did was we gathered a team of experts across Siemens, and these are folks, engineers that have done this time and time again, and brought them to what we call a bit of a roundtable type of discussion with management. Ideation was really the initial stage of this initiative, but ultimately, what we're able to do is hone in on the projects that made the most sense. With agreement from the sponsor, we're able to fully scope out these projects for electrification, increased electrified moving equipment, and overall sort of system integration. Now, keep in mind that much of this Siemens did not execute, and some of it we did, but we really pride ourselves in being agnostic as to who the execution partner is. We believe that being a valued partner will ultimately pay dividends, and this is how we provide our incremental value. We've also worked with PE firms where their portfolio companies were not borrowers of ours. We recently worked with an industrial-focused private equity sponsor, speaking with them about areas where we could create energy efficiency within one of the portfolio companies. Didn't seem to work out so well, but what they noticed was that what we were providing was applicable to many of their other portfolio companies. And again, we went through the same initiative, brought together the right people within Siemens, advised them on what could be done and what couldn't be done. Again, feasibility, timeline, cost, ROI, gave them the tools and the facts that they could then use to decide if this was, which was the right plan to go ahead with, and really allocate resources accordingly. And that's another example of us, finding ways to add incremental value other than just being a lender. I think there are really two takeaways here. I think for one, we know that our private equity sponsors' time comes at a premium, certainly in this market. And then also to hone in on the right areas of focus, it is really important to hone in on the right partner. so that you're able to get the right answers, establish the right fact pattern, and make the right decisions.
Tom, thank you so much for joining Growth TV to share these insights.
Thank you, Carol.